At Ines Group Berhad, we have built a strong foundation as a Malaysia-based edible bird's nest company. Our subsidiaries Mingfeng and Dynamic Transforms are among the top 10 Malaysian companies exporting raw, cleaned edible bird's nest to China, reinforcing our position as one of the leading market players in Malaysia's edible bird's nest industry. Looking ahead, we are focused on long-term growth and value creation. Our plans include manufacturing bottled bird's nest and other herbal beverages in-house, giving us greater control over quality, product development, and formulation flexibility.
In Malaysia, over the past 4 decades, Hock Soon Poultry Farm has evolved from a humble family business into a leading force in modern agriculture. Today, Hock Soon produces over 1.5 million eggs daily, with operations spanning more than 20 hectares. Every day, freshly laid eggs are transported via conveyor belts into our facility, where they pass through multiple inspection stations. Hock Soon's in-house brand, Q+, has been serving the nation for over a decade. The range includes omega, selenium, vitamin E-enriched eggs, and jumbo-sized eggs. Hock Soon Poultry Farm, nurturing quality from farm to table.
What would happen? Machines run. Operation stopped. Tables are dirty. Business halted. Store closed. Staff gone. What if you had Manforce Group? With Manforce Group, every step is handled. Every risk is managed. Every regulation met, from permits to paychecks, ensuring legal, fair, and quota-compliant start. Partner with Manforce Group right from the start. Powered by Manforce Group Berhad.
Where creativity meets strategy, and where brands are built on innovation and insight. We provide a complete 360-degree marketing and sales solution, creating real-world exposure through business events, awards, and networking platforms. We then strengthen online presence through digital content, media exposure, and performance marketing. To reinforce awareness, we extend the message offline through billboards, banners, and digital out-of-home media.
KleverStock is a content-driven financial media and investor insights platform. We integrate live stream coverage, educational content, market data visualization, and AI-powered tools to support investor understanding and engagement. In the past year, we achieved significant momentum across our operations and market visibility. We delivered nearly 99% of all IPO and listing day live stream coverage, featuring executive interviews, ceremony broadcasting, and real-time market updates. We collaborated with major corporates including Foodie, Aquawalk, and many others. We also expanded partnerships with investor relations firms, trading platforms, and marketing agencies. KleverStock is now ISO certified, and our official media accreditation has been renewed, enhancing governance, access, and professional credibility. Our content performance continues to grow rapidly. We achieved over 10 million impressions across social platforms, 1.2 million unique visitors in 2025, and more than 630,000 live stream views driven by our IPO and market coverage. These results reinforce our growing influence and visibility across the financial community. We advanced our technology with Phase 2 of our AI engine, enabling smarter sentiment tracking, automated summaries, and improved market screening. Our priorities for 2025 include strengthening strategic partnerships, enhancing our IPO and corporate livestream capabilities, expanding content production, and accelerating AI-powered investor tools. We remain focused on innovation, consistency, and delivering market-relevant insights. KleverStock remains committed to growth, technology advancement, and delivering meaningful impact to our clients, partners, and audiences.
In a world powered by data, Electricity is not optional, it is foundational. Every transaction, every connection, every system depends on it. Electricity sustains industries, enables digital ecosystems, and underpins modern life. Economic growth depends on stable infrastructure. Digital expansion depends on reliable power. EI power strengthens the systems that sustain both. We engineer certainty in environments where certainty is required. EI Power Berhad, powering tomorrow.
HSS Holdings Berhad, where we transform the finest bakery products into accessible delights for everyone. We combine premium quality with affordability, driving product innovation and leveraging our extensive distribution network to reach more markets, mini market, supermarket, and hypermarket. From HSS to LHMC and Kasaga, our commitment to quality, innovation, and customer satisfaction drives us forward. Join us in bringing incredible bakery products to the world. HSS, your trusted partner in bakery excellence.
Go!
Good afternoon, investors. You are now on KleverStock with me, Madhavi, and I'll be serving you the midday roundup with the latest updates from this morning up until now. And we are kicking it off with updates from our local bourse. Bursa Malaysia is poised to benefit from a regional relief rally as concerns regarding an overheating United States economy begin to dissipate following a recent jobs report that indicated cooling momentum. Asian financial markets have experienced a notable resurgence in buying activity, particularly within the technology sector, as indications of easing U.S. inflation have lowered the probability of the Federal Reserve tightening interest rates this year. Market analysts suggest that the recent volatility in regional technology equities may have been temporary. Financial research firm APAC Securities indicated that the downturn was likely a brief sentiment-driven phase rather than a prolonged structural adjustment, which could ultimately revive interest in Malaysia's technology and semiconductor-linked stocks. APAC Securities noted the Asian tech unwind may have been a short sentiment-driven air pocket rather than the start of the deeper de-rating and should help restore risk appetite for Malaysia's own chip-linked proxies. However, the research house also cautioned that the trading volumes could remain light during the week due to the lack of immediate local triggers and the extant Independence Day holiday in the United States. This reduced liquidity could leave the domestic bourse susceptible to sudden news-driven market movements. Domestic market participants are expected to shift their focus toward key local developments later in the week, specifically the central bank's upcoming interest rate review and regional political developments. APAC Securities stated Bank Negara Malaysia's Monetary Policy Committee meeting on July 9 will be the key domestic catalyst to watch, with the OPR widely expected to be held at 2.75%, adding that the upcoming Johor state election on July 11 introduces an element of domestic political risk that might impact investor sentiment. The firm concluded that on balance, investors should remain cautious in the days ahead. In early trading, the benchmark FBM-KICI showed little movement, hovering nearly flat at 1,679.51 points shortly after the opening bell. Despite the quite broader market, several individual counters attracted notable buying interest. Heineken Malaysia Berhad rose by 20 cents to 19 ringgit 50 cent. KLCC Property Holdings Berhad gained 13 cents to reach at 8 ringgit 99 cent, and PTT Logistics Berhad advanced 9 cent to trade at 1 ringgit 59 cent. Among the most actively traded shares, AMS surged 6.5 cent to 48 cent, while Tanco Holdings Berhad and Nextgram Holdings Berhad remained unchanged at 17.5 cent and 5 cent respectively. Moving on to a local currency and foreign exchange. The Malaysian ringgit started the week on a stable note against the US dollar, trading mostly unchanged on Monday morning. Investors are currently recalibrating their expectations regarding future United States interest rate and adjustments in the wake of weaker than anticipated US non-farm payrolls data. At the opening bell, the local currency was quoted at 4.0695 or 4.0780 against the greenback, presenting a minimal shift of Friday's closing rate of 4.0690 or 4.0735. Market experts suggest that the currency's current resilience is heavily tied to the cautious stance maintained by American policymakers. Bank Muamalat Malaysia Berhad Chief Economist Dr. Muhammad Afzani Sam Abdul Rashid noted that the local note stability was largely supported by the US Federal Reserve Chair's hesitation to offer definitive forward guidance on interest rates. Looking ahead, the financial markets are bracing for a highly significant week that could dictate the ringgit's trajectory over a short term. According to Dr. Muhammad Afzani, some investor attention will be fixed on two major economic events occurring on Thursday, July 9. He stated the U.S. Federal Open Market Committee minutes to be released this week will be the main focus apart from Bank Negara Malaysia's Monetary Policy Committee meeting on Thursday. While the ringgit held its ground against the dollar, its performance was less robust when measured against other international and regional counterparts. Against a basket of major currencies, the local note experienced a downward trend as trading commenced. It softened against the euro, moving to 4.6543 or 4.6640 from Friday's close of 4.6497 or 4.6612, and dipped against the British pound to 5.4336 or 54.4449 from 5.4296 or 5.4430 last week. Conversely, it managed to pose against the Japanese yen, strengthening to 2.5203 or 2.5257 compared to its previous close of 2.5214 or 2.5277. A similar pattern emerged in regional trade, where the ringgit generally yielded ground to neighboring currencies. The local note weakened against the Singapore dollar to 3.1500 or 3.1571 from 3.1483 or 3.1563. At the end of last week, they fell against the Thai baht to 12.2627 or 12.2942 from 12.2384 or 12.2744. Furthermore, the ringgit recorded minor losses against both the Indonesian rupiah, slipping to 226.5 or 227.1, and the Philippine peso, which moved to 6.62 or 6.64. Now for some economic news. The Federation of Malaysian Manufacturers, FMM, has called on the United States government to adopt a more measured approach regarding its proposed Section 301 tariff action aimed at imports tied to forced labor. The industrial group cautioned that sweeping blanket duties could unfairly penalize compliant Malaysian companies and trigger widespread disruptions across well-established global supply chains. In a formal submission to the Office of the United States Trade Representatives, FMM President Jacob Lee Chorcock emphasized that while the Federation completely backs international efforts to eradicate forced labor from trade networks, new tariffs should not harm manufacturing firms that already adhere strictly to rigorous international employment standards. Lee stated, many Malaysian manufacturers exporting to the United States already operate under strict customer-driven labor compliance requirements, including audits, supply codes, and conduct traceability obligations. The manufacturers' body further warned that the implementation of additional duties could backfire on the American economy itself. By inflating costs of U.S. importers, domestic manufacturers, and everyday consumer, the tariffs would create an unnecessary economic burden, particularly within highly specialized long-term supply relations where Malaysian business serve as vital links. Feedback collected from FMM members indicates that these heightened costs would likely be passed down, either partially or entirely, to American clients. Such a shift could trigger direct consequences for product pricing, localized availability, and delivery schedules. To mitigate this risk, the Federation outlined several key recommendations for the USTR. Chief among these is retention of existing Annex A exclusions, which cover critical products lines such as semiconductors, electrical and electronics items, and related components deemed foundational to global technology infrastructure. Furthermore, FMM insisted that Malaysian goods currently subject to Section 232 tariffs should be spared from overlapping duties under the new Section 301 proposals. Lee explained, a key recommendation in FMM submission is for USTR to establish a periodic review mechanism at minimum annually to assess the continued necessity of appropriateness of any duty rate applied to Malaysian origin goods. Lee highlighted that Malaysia has aggressively advanced its domestic labor framework over recent years. These enhancements include tightening regulations around recruitment fee practices, enacting structural labor law amendments, and introducing robust remediation measures following past withhold release orders issued by U.S. Customs and broader protection. He pointed to the creation of the Interagency Task Force on Forced Labor, which was formally introduced by Investment, Trade and Industry Minister Dato Sri Johari Abdul Ghani in Parliament as clear proof of the nation's proactive regulatory stance. Lee also added FMM is of the view that Malaysia's ongoing reform efforts should be recognized in any future assessment by USTR, noting that a structured review mechanism would ensure domestic progress is assessed fairly over time. Moving forward, the FMM intends to maintain open communication with the Malaysian government, the USTR and international stakeholders to support technical labor practices without sacrificing competitive trade and supply chain resilience. And we'll now take a short break, but don't go away. We will return shortly with corporate news and developments. Welcome back to the Media Roundup. Let's continue with some corporate updates. The recent mega merger between Omnicom Media Group and Interpublic Group aims to give clients better access to advanced technology, talent, and specialized tools. This shift comes as modern brands demand that their marketing budgets drive clear business growth rather than just standard advertising metrics. Omnicom Media Group Malaysia CEO Darren Yuan noted that clients now expect marketing investments to directly impact the bottom line. Brands want to move faster and require deeper agency expertise, especially as technology raises and the bar of the industry accountability. Today's marketers focus on 6 core pillars: linking investments to growth, unifying data, increasing speed, using AI responsibly, scaling content production, and embedding e-commerce into all customer interactions. Yuan said, "What are we looking at is measuring our marketing investments against business growth, which includes accountability, agility, and content creation. To scale that growth, clients want to move faster, and what they are asking for is inherently a deeper set of skills, and now we embrace technology in our marketing execution in an important factor for us as an agency." Artificial intelligence plays a massive role in the evolution. While marketers once struggled with overwhelming data, AI now allows agencies to identify market trends and opportunities much faster. Yuan dismissed the idea that automation will replace humans, emphasizing that AI is meant to enhance human creativity by drastically cutting content production times from weeks to days. Yuan remarked, "The strongest examples I've seen involve also using AI to increase relevance and speed," adding that the future belongs to companies that the best combine human imagination with machine intelligence. While the global merger includes a workforce reduction of roughly 4,000 roles, Yuan clarified that the Malaysian office is focused on restructuring for efficiency and boosting capabilities rather than simple downsizing. The goal remains to build the strongest marketing services group in Malaysia by investing heavily in leadership and new tech tools. Additionally, despite global decisions to retire some legacy agency brands, Omnicom Media Group Malaysia will keep all its local brands active due to their strong market track record and established client trust. UN stressed that also agencies must value true expertise over mere nostalgia to help clients evolve. He also mentioned high-performing organizations understands the difference between heritage and nostalgia. Heritage is valuable because it represents expertise, culture, and client trust that have been built over decades. However, when the conversation centers on underlying nostalgia, it becomes a problem, especially if it prevents clients from evolving. Ultimately, the competitive edge will go to marketing agencies that can analyze data and act faster than their rivals, giving brands the confidence to make quick, impactful business decisions. And up next, we have the stock updates. Local institutional investors maintained their strong momentum in Bursa Malaysia, extending their net buying streak on 12th consecutive week with a net inflow of 474.6 million ringgit last week. According to the latest fund flow report by MBSB Investment Bank Berhad for the week ended July 3, 2026, this sustained domestic support countered ongoing foreign selling as foreign institutions remained net sellers for the 8th week of a row, charting net outflows of 391.1 million ringgit. The results noted that offshore investors pulled funds out of the local bourse during the majority of the trading week, though the pressure eased by the weekend. MBSB research stated foreign investors were net sellers on 3 of their 5 trading days last week, with the highest outflows recorded on the Tuesday, 183 million ringgit, followed by Thursday and Wednesday. The largest inflows were recorded on Monday at 55.4 million ringgit, followed by Friday at 11.7 million ringgit. Sector by sector, data revealed divergent interests among international investors. The technology sector emerged as the top pick for foreign capital, capturing the highest net inflows at 41.6 million ringgit. This was followed by the transportation and logistics sector, which drew 26 million ringgit, and the construction sector at 22.2 million ringgit. Conversely, heavy selling was concentrated in key blue chip sectors. The financial services sector experienced the heaviest hit with net foreign outflows totaling 252.2 million ringgit. The consumer products and services sector also saw notable foreign liquidations amounting to 60 million ringgit, closely followed by the healthcare sector at 59.3 million ringgit. Overall market participation cooled down across the board during the week. The average daily trading volume experienced a universal decline, dropping by 12.7% among retail participants, 23.3% among local institutions, and 5.9% among foreign investors. Finally, wrapping up, we have major corporate developments and the deals across Malaysia. UEM Sunrise Berhad has appointed Exim KLCC Sdn Bhd to develop its 1.6-acre freehold site in Kuala Lumpur into a mixed-use project comprising a hotel residence, and a retail mall under a development rights agreement. Insas Berhad has disposed of 150 million shares in Inari Ametront Berhad for 318.1 million ringgit cash, trimming its investment in the outsourced semiconductor assembly that has provided to 5.70%. Genting Malaysia Berhad, indirectly subsidiary Empire Resorts, has scrapped its proposed capital restructuring after fully redeeming its $300 million senior secured notes due to November 1, 2026. WTK Holdings Berhad is selling its 65% stake in palm oil unit Positive Deal Sdn Bhd, as well as 5,548 hectares of plantation land in Miri for 221.5 million ringgit cash. Kuala Lumpur Kapong Berhad is facing attribution proceedings initiated by PT Pertagas Niaga against its subsidiary PT Perindustrian Sabit Synergy over the termination of a gas supply agreement. Hexter Industrial Berhad has secured a 138.4 million ringgit contract to provide engineering, procurement and construction works for industrial developments in Pulau Indah, Selangor. QAS Group Berhad has proposed a private placement of 83.3 million new shares, representing 10% of its issued share capital, excluding treasury shares, to Raytax Singapore Private Limited for 53 cents per share. And that's a wrap for Midday Roundup with me, Madhavi, on KleverStock. Thank you for choosing us, investors. Stay tuned for our upcoming live stream programs.